Thanks very much, both of you, for being here for this. So this panel is on SPACs, and I think the title of it is Blank Check or Blind Faith. So I'm going to start by just assuming that there are at least some people in the audience who, like me, are not completely familiar with the workings of SPACs and sort of what they represent in the market. So I explain them a bit like this. It's a platform essentially where guys like you can get investors to give you some money. You can say, we're going to do a deal with it. We don't know exactly when. We don't know exactly what the deal will be. But to make it worth your while, we're going to give you another piece of paper, a warrant, which at some point in the future may be worth a bit more than it is today. Doesn't that all sound kind of like a late cycle model?
I don't know what a late cycle model is. I mean, I'd say a few things. Not all SPACs are the same. Some they originated from very small vehicles with very high fee structures, more in sort of for venture type companies. What's evolved and what Chinh and I have been doing is on a larger scale, investing capital in some ways like private equity, but with permanent capital. Some are truly blank check companies, and some are blind faith companies. The vehicles that I do don't provide a vote or a redemption feature. A lot of these vehicles do. As a pro quo for that, there are no free shares. We only make money when shareholders make money. So the alignment structures are different. Today in America, you still have a lot of SPACs that do it, if you like, the traditional way. I happen to think that they're not aligned the way I would like to see them aligned, and I think you would see in the track records of the smaller SPACs particularly that it results in deals that are tougher to get done.
And both of you two have done fairly big SPACs, and both actually have fairly big SPACs at the moment that have yet to do deals but are sort of out there hunting. Chinh, come in on this. If I'm a family-owned company and I'm looking to do some kind of exit, why go with a SPAC? Why not go the traditional IPO route or indeed private equity when there's so much capital available and you would expect a fairly robust process if you did so?
I think first, the first question, I agree with Martin. There are a lot of different types of SPACs, different tiering of SPACs, different quality of sponsors. And I think it originated from a very different time. I think today's SPAC, the 2.0 version, has a lot of different elements, including higher quality sponsors, significantly better or blue chip shareholders, and it becomes a snowball effect, which then attracts the best companies. And it's a real viable solution in lieu of an IPO. In the last 2 years, and certainly in 2019 as well, you've seen the SPAC market account for anywhere between 15 to 20% of the IPO volume. Pretty significant portion. So it's its own sub-asset class within the IPO market. Your question regarding family-owned businesses is a good one. A family-owned business would like to go with a SPAC because it wants a customized, catered solution. Number one. Number two is that the SPAC sponsors could oftentimes provide a halo effect or a partnership with the IPO selling family to provide a higher valuation and more expertise. And then oftentimes the family selling the shares in an IPO have never gone through an IPO before. So it's going to Wall Street the first time, whereas people like Martin, who's the grandfather of the SPAC industry, and myself, we've done it many, many times. So it's a combination of a customized solution, it's a combination of a partnership in terms of providing a halo effect, as well as the expertise and experience as well.
But isn't that just saying, essentially, the owners, the current owners, are giving up ownership to have people like you or Martin come in versus going out and asking someone like Goldman or JP Morgan, hey, can you actually help us through the process of taking this public?
So if you talk about a family-owned business, family ownership usually, this isn't that they just want to take their company public. Typically, companies that go public sell, call it 20% of their business to the public. They have a really pretty tight float. They then do a secondary later. I mean, that's the typical model. They also have to go around and meet a whole bunch of investors and explain to them their story and sit with a bunch of kids sometimes in places they don't want to be. Principal owners who have built their family businesses often don't want to do that. With a vehicle like a SPAC, the size of if you like, the selling shareholders' liquidity can be far greater. They could sell 100% of their holding. They could sell 80% of their holding. The the percentages are usually far greater. And at the same time, they don't have to sell their story to anybody other than the partners, the principals that they're talking to, which is much more akin to the private equity model. And at the end of the day, the first time the public sees the light of the transaction is when the deal has already been set and the price is fixed. So it's not like they're going out there with an unknown as to what they're going to do. So they can control the process a lot better. There is a price to that, and that depends again on the structure that these SPACs are set up with.
I would, however, agree with Martin, but I would, however, say that the price for that can be more than obviated if the sponsors are value added, if the sponsors add that halo effect that increases the multiple or the valuation of the company, i.e. the dilution from the SPAC warrants, from the SPAC economics could be more than obviated. And in fact, the goal is to increase the value of the pie. And oftentimes with high quality sponsors, we do that. So in our SPAC, a consumer SPAC, we not only have myself and Jason, who used to lead the consumer practice at Blackstone, we also have a gentleman, Roger Deromedi, who was the chairman of Pinnacle, which is a terrific success story in the public market, and formerly the Kraft CEO. So presence of a gentleman like Roger to be part of the deal increases the valuation, we think, of the company and prestige of the company.
I want to come on to what you both look for in deals in a moment, but before that, I want to get into what you want in terms of investors, because traditionally, when I think of SPACs, I think of really the hedge fund shops. A lot of people come in from the hedge fund industry, and it's a sort of arbitrage opportunity. They can often get out before a deal is even done. How is that changing, and how do you attract in a different class of investor?
I think it goes back to what Martin said. There are different types of SPACs, and it comes in a lot of flavors. The investors are very important. You can certainly have a bunch of hedge funds, or what we did with our current SPAC, which is called Collier Creek, we really went out of our way to attract the blue chip investors like the T. Rowe Prices of the world to be in the SPAC. So the top of our book would be filled with the mutual funds and the fundamental investors, which is important because they are longer term shareholders. They are more attractive with potential sellers, and it changes the whole story of what a SPAC is. In our first SPAC, CF Corp, where we raised $1.2 billion, we also had a structure where we had anchor investors that cannot redeem, and they're very, very long-term investors as well. So I think the investor base is very important, and it's a combination of who the sponsors are and who the investors are that frankly would help you attract the high-quality companies. I don't know, Martin, how do you feel about that?
So, and I agree with a lot of that. I think the problem with a lot of the smaller SPACs, and probably the bottom, I don't know the percentage, but the bottom shareholders of every SPAC that's in the US, is you have the arbitrage play. And why do you have an arbitrage play? You have warrants, you have shares. But because of the US structure where cash is held in a trust, you can go to a prime broker and borrow 10 to 1 on that money. And so what ARBs tend to do is they come in, they buy the unit, they sell the warrant, they have the redemption right. They don't really care whether you do a deal or not. In many cases, like some funds I know, they're not even allowed to own a share after the closing. So it's sort of phony capitalism because they don't really have the money. And I'm not a big proponent of that. That's, I'd rather not do a SPAC than have one.
Do yours have votes? Because yours are in London.
Ours have no votes. They're raised in the UK because the US doesn't allow the structures that we use in some aspects of what we do. But we have no vote. We have no free shares. We have a much more restricted type warrant structure. But the big difference for us, why we list them in the UK versus the US, is for the bankers, the fee structures have a night and day. I mean, I spend between 1% and 2% to raise the money in the UK. The average here is, I think, 5 to 7. Split between when you raise the money and when they do the deal. But think about it. If I told you to go shopping for a car, but you could pay $15,000 or $30,000 for the same car, I don't know what you're going to do. Well, I kind of do know what you're going to do. So we've chosen to go that route. It's harder money to raise. I think people like Chinh and myself, and a handful of others, where you really are playing back the jockey for a vehicle that you're buying a share and you're in it for the transaction, not for any other reason. It only attracts the more institutional players, whether it be hedge funds that have true long-term desires to back a management team with a track record, or institutions like T. Rowe, Wellington. I mean, for us, Our anchor investor is Viking, put $250 million in our latest vehicle. T. Rowe, Wellington, all these, traditional
But long term here means what? Because I'm assuming both of you go into these deals with an exit plan or at least some kind of time horizon in terms of you don't want to own these assets forever or at least operate them forever.
I do. I mean, I want to this. Nomad, an Element, the two companies we're in at the moment. I'm happy to own for my grandchildren. I'm not in it to make fees. I'm in it to own it. And long after the carries are over, and the tax structures allow dividends to be paid, they're going to become dividend players. That's what I'm playing towards. I mean, my goal of doing these vehicles is very simple. I want to create a portfolio of high quality businesses that I can influence outcomes on without actually running them day to day for a very long period of time. Buy great companies, build them. And you have to do that on scale. The reason I think you have an advantage is, we've had to have large pools of capital is you can buy higher caliber quality companies on which to build. So it's not it's one of the pitches that we make. Permanent capital, renters versus owners. Private equity by definition are renters because they have to sell. Permanent capital are owners. That's the way I see it.
I agree with that. We look to buy businesses that can compound, have enduring value, and we want to own it for a very long time. This is not a private equity model.
So then in terms of when you are going out to look for deals, what kind of characteristics do you look for? Because these companies typically are, it's a one-shot vehicle, the SPAC. You don't get to go out and do deals and deals and deals like you would as a private equity shop and hedge against some of them doing less well. So what are you looking for and how do you actually get a deal that your investors are going to support? Because presumably you can't bring everyone over the wall pre-deal.
We look for companies that have long-term value creation, companies that have strong fundamentals that you can win many different ways. Organic growth, acquisitions. We look for companies that we can improve from a management and operational standpoint. But fundamentally, it has to be a good company. This is not a 3 to 4 to 5 year play. It has to have the ability to compound for a long time.
I look for 5 things. They're the same things I looked at when building Jarden for the last 15 years. Market leaders in niche markets, companies that have defensible moats around them of one kind or another, a strong management organization, a long history of high free cash flow generation. I like buying companies for cash flows. That's it. And finally, that they can be bought at a reasonable multiple of those free cash flows.
And then once you've done the deal, you have to obviously convince the market, even if you have long-term shareholders, you have to convince the market that this is a good deal, that this is a company that's going to have success. So how important is that, getting the narrative right? And I ask because we're in an IPO market at the moment where we've seen a lot of companies really blow up because they didn't get their narrative right. They've come public with massive expectations and have sort of tanked on opening and gone down and down from there.
At least for us, because we don't have to get the blessing of shareholders, we have to get the blessing of our board. We obviously, if you like, market test some of the things that we're doing. In our case, having a $250 million investment from a hedge fund that also has a seat on our board is a really good qualifier of how the market will think about things. But we're sort of very disciplined about how we think it should trade out of the box. If you look back at all our vehicles, they've traded very strongly out of the box. And that's because they're positioned correctly. But you always have to go out and tell the story. The difference is at least in the timetable of the things that we've been doing, you announce a transaction, there is a period of time between the announcement of a deal certain and when it trades. So you have plenty of time to actually go out and tell the story. You don't have restrictions on getting research written, that you do have in traditional IPOs. So you can have research written for investors to absorb the story before it actually begins to trade. There's a lot of factors that go into it, but for different SPACs, there are different methodologies that you have to do that.
One of the advantages of SPACs over IPOs is that you can go to some of your large core investors and cross them over the wall and talk about the story.
Before the deal?
Before the deal. Go deeper into the story, have a penetrating discussion regarding projections, fundamentals, and I think that's your market test. And these are investors that we trust and we rely on, we respect. And that's a very different process in the IPO, where it's a 30-minute meet and greet meeting. And if you get your top 3 storylines done, you can sell it. But this is a deep, penetrating look under the cover of the company.
So take us inside that, sort of how many deals might you look at and then bring investors over the wall and then decide, actually, we're not going to do this because we don't have enough support or because there isn't enough consensus among the shareholder base?
I think the funnel is a very typical funnel. We look at a lot of deals. We are very selective of deals that we spend time with, and I think the characteristics of the deal must meet our criteria and must meet our board's criteria. But once we cross the Rubicon of actually wanting to do a deal, we haven't had an example of our investors turning it down because I think we know what our investors want. We've been in this business for a long time, and we think along the lines of how our investors think. We're completely aligned with them. We have a lot of our money at stake here.
I want to talk about alignment because obviously that's another important issue here. Martin, you and I have discussed this previously, that in some SPAC models and some of the ones that have done badly historically, the alignment is kind of way out. The shareholders have one thing, the management make money regardless of how well the deal does, which can incentivize them to go out and do a bad deal. Are you seeing a trend among SPACs being raised that we're moving away from that and towards a more sort of like-for-like alignment between management and shareholders?
I'd say it's typical with all bandwagons, probably not enough. I think the right way to do these structures, and I say this taking money, I guess, out of my own pocket, is I think you should make money when your shareholders make money and not before. And I started out with structures that were traditional, and I saw situations where I could have made a lot of money and my shareholders made no money. And I just didn't want to do that anymore. And so we pivoted to a structure where there was complete alignment. It's much more like private equity, just without the fees.
So you get no fees for just doing the deal?
We get a management fee that at most covers our costs, but it's a fraction from what a private equity firm would charge, 1-2% of the capital while they sit on hunt for deals. There's none of that in SPACs in general. I think the alignment, when you actually do a quality transaction, particularly when you do them at scale, I think you do a better quality transaction when you have complete alignment with the people you're sitting on the opposite side of the table with. Because they're sophisticated, they do the math, they understand what it costs. And at some point, the frictional cost is too great unless you're sort of desperate, in which case, you have to question whether or not that's the right transaction for you. You can get into negotiations. I mean, I think a lot of SPACs get into negotiations as to whether or not they're going to modify their fee structures and things like that. This sort of obviates that part of the equation. It doesn't completely obviate it. I mean, you're still getting a carried interest that, a bit like private equity, is still a frictional cost to the end shareholders. But you make money when they make money, which people understand.
Chinh, come in on this because it does seem like it's an important issue, particularly if you're wanting to attract the kind of, as you say, the blue chip investors, people who are going to be in there long term, that they don't feel that there's a possibility of you, the owner, going out and doing a deal which is potentially very good for you, but less good for them as long-term shareholders.
Part of it is how much capital do you have at risk? There's a lot of SPACs out in the market where the only capital the sponsors put in would be the risk capital, 2% of the deal. We don't think that's enough. We think in addition to that, you must invest significant capital on top of that, and we do that in every one of our deals. The other thing that we do in both of our SPACs is that we've also had a very high-quality manager associated with it as well. And the manager's putting his or her money involved in it, his or her reputation, and all of those align the interest with the investors.
In the case of CC, that would be, you're saying Roger, someone like that who's actually come in with a background in this. And what's their commitment, aside from investing in the SPAC? Do they have some commitment to actually stay on and run the asset for a certain period of time? I mean, if I'm an investor in a SPAC, I would want to know, are they going to be around for the long term?
Yeah, so Roger invests his own money. He will commit to stay around. He probably won't run the company. He'll play the role of his executive chairman if it's appropriate. But effectively, he will help set the strategy, help recruit the management team. Oftentimes what Martin has done in the past. It's not running the company per se, but he's the core element of the strategy of the company. But yes, Roger will stay around.
Another area that I want to kind of go with this is, if we're in this environment where you have just an abundance of private equity capital, I think it's record amounts now, over $2 trillion of dry powder, on the sidelines. When you're going out to look for assets, how competitive is that environment? Sort of how many people, how many times, I guess, do you run up against, the likes of Blackstone or KKR or Carlyle competing for these same assets, and therefore you're having to go in on more aggressive terms?
Well, I speak for me. I don't compete in auctions, so I don't bump into private equity too much. I think when it comes down to, if you like, the pitch, I could say what I said earlier. I sit with this pitch about renters versus owners, and imagine you have an apartment and you got a scratch on the wall. If you rent it, you put a poster over it. If you own it, you fix the wall. And you
have to be nice. Chinh worked in private equity for a very long time.
But he left.
He did.
But that's I think that's the biggest selling point. And I think the disciplines of being public are for all the talk about negatives about being public. The positive is it's great operating discipline. The reporting structures, the budgeting, the internal control systems, all of those things make your company a best practice company. And it's permanent capital. It's a great structure to be in if you run it right.
If you draw a Venn diagram and you track the companies that want to go into private equity route versus the ones that want to go in SPAC, very little overlap. Because if you go private equity route, it is a 5-year duration. It is with a lot more leverage than a SPAC, and it's going private, not going public. Whereas a SPAC, you have a long duration. You don't have this worry about renting versus buying. You're there for a long time. You don't have the high leverage associated with it. And it's a very different thing because you're going public instead of going private. So we don't run into it much. And then what we do is, as I said, we add have one additional element, which is we partner with a Water Walker management team or CEO to increase the halo effect of the valuation of the company.
Okay, before I let you both go, I just want to ask, you both have obviously clocks on the investments or on the vehicles that you have out there. I know, Martin, you have till October, and then you can potentially extend. How close are you both to actually doing deals with these SPACs?
Well, I don't want to make any license plates for the rest of my life, so I'm not going to comment too much on that.
You don't need to tell me which asset. I mean, you can, obviously.
I will say that we can extend our vehicle for another year quite easily.
With a vote?
It requires a vote, but the vote is in a handful of hands that I already am very close to. So that's, I don't think, is an issue for us. But I don't think we're going to need to do that. That's probably as much as I would say.
And Chinh?
You have a bit longer. We have a longer time, and we're working hard. That's all I'll say.
Guys, thank you so much for joining me. Just a quick note before we wrap up. There is lunch now, and I think some staff are actually going to be here to show everyone up to the 28th floor where it will be served, and then come back 1:25 for the ESG Quant panel. Thank you very much. Martin, Chinh, thank you so much for the time.